Shell is cutting up to 9,000 jobs in a virus-induced restructuring. The CEO, Ben van Beurden, said the energy company was moving to be a more streamlined and competitive organisation. The revamp is projected to save as much as $2.5 billion by 2023. Joining us now is Laura Hurst, our oil and gas reporter. Laura, why is Shell doing this? How much of this is coronavirus-induced and how much of this is about the long energy transition we were already talking about?
Well, it's a mixed picture for sure. From Shell's perspective, they're saying, look, in April, we outlined this ambition to really slash our emissions and change the nature of our business to become a cleaner company, a more green company. And it seems from their perspective that COVID has simply accelerated the pace of change. So it's not just COVID that's caused these redundancies. It's something that the company was gearing to anyway.
And how does this plan from Shell compare to peers in the industry? We heard earlier on this month extensively from BP during BP Week about their plans.
Yeah, so basically we're seeing the majors cutting costs and headcount quite aggressively. And BP said earlier this year that they're going to cut about 10,000 people, so more than Shell. And similarly, Chevron and Exxon have already started cutting headcount as well. So it's becoming quite a standard thing across the industry and across majors.
And what is the outlook for Shell then at this point as it tries to manage this really complex transition, just like others in the sector are doing? What is the outlook for the business?
Well, it's quite a tricky one at the moment. They said this morning that they're going to expect oil product sales come down quite fairly from last year, as that we're still seeing an impact of the coronavirus on demand. And in fact, just yesterday, we heard a lot of the top oil traders from Vitol, Mercuria, Trafigura reflect this feeling that demand is still yet to come and could take another 18 months to go back to where we were before the virus.